Hey everybody, it is Wednesday evening, and I stumbled across this stock, STNE. I didn't stumble across it because it's been on my list for a while. This is one that had been a big winner after their IPO in 2018. We can put an anchor on that. And then, of course, the 2020 low, we can put an anchor there and off of this all-time high, which you can see. Let's just clear everything off so we can see that. The anchor off the all-time high has held this stock back recently. But what we see on this weekly time frame is that this prior band of resistance is where we're finding that support as well. Now, the earnings are due on this company on the 13th. What really has me interested in this, and I say this in all sincerity, is that one of the worst managers of money just sold their last shares of this stock today. It's insane. So let's talk about this. This is this site, by the way. I get an email that tells me what they did each day. Kathy's Arc is the name of the site if you're looking to get their email. Anyways, what it does is it shows what the Arc funds do with their stocks, and you can see that over here. What just to show this little table, it shows that as of May 3rd, 2021. They had 318,000 shares at an average cost of $63.43. Well, they stepped up their purchases quite rapidly up to a maximum of 3.1 million shares. And at that point, if you look in here, it's tough to see what the average cost is. Looks like they got their average cost all the way down to $52 per share as of that peak in November of 21. So let's take a look again where we were in November of 21, where they stopped buying. They stopped buying in November of 21 right here, maybe on that gap lower. They finished their dip buying. Well, then what happened? Well, as they established their position at an average cost of $53 per share, we'll go to that in a moment. I want to go back to the picture of where did it go? Here we are. So that peak in their position occurred pretty much near the bottom, which we'll give them credit for, sure. But they sold some of this stock as the stock started doing basically nothing. So from that peak position of November in 21, they sold a bunch. They sold about 1 million shares over the next year as the stock went sideways here. So they reduced their position by about 1 million shares. So when the average cost was $53 up here and they sold it down here at 15, it means they lost about 40. It's crazy to think, but $35 per share. Anyways, let's continue to see what happened. Well, something happened in here in December of last year, January of this year. They said, you know what? These 2 million shares that we have, forget it. Enough's enough. Our average cost is up here north of, let's see, the average cost was $45. So their average cost was $45, and they had 2 million shares at the beginning of this year. So let's switch to the daily time frame. January of this year, that's the volume weighted average price. So you can see the stock has had some pressure from someone. Maybe it's just their account, but 2 million shares, the average daily volume is 4 million. It's not just the ARC fund selling it that got us out, that got this stock trapped underneath that anchor. However, when you look at it, now they're out of this stock. So they are out of, they've got, looks like they've got 22 shares left. Maybe they're waiting for them to come back and they can break even. I say that facetiously, of course. Anyways, enough of what's going on with that ARC fund. The good news is the dumb money seems to be out of this stock. She realized that it was better to take a $35 loss per share on, what did we say, 4 million shares? I don't remember, 3 million shares. 2 million since the beginning of this year. So, locked in maybe an average of $17 per share. Again, lost $35, $36 per share. Just insane. Well, let's take a look at that market surge chart, because this is where it gets a little bit intriguing. One, earnings are due on May 13th. As we've already said on this longer term chart, this prior band of resistance seems to be holding a support, and it's trapped under the anchor from the all-time high. If it can get beyond that, then you've clearly got a nice air pocket that really looks like it should bring it back up towards about $30 per share. So there's some good upside in this. The issue, again, is May 13th is their earnings. Well, let's look at their earnings history. last 4 quarters, they've increased their earnings by 389%, 474%, 306%, 204%. Revenues have increased 23%, 41%. So it's growing strong. This year, the earnings are supposed to be 26% bigger than last year. Next year, 18% bigger. So if you look at it, on these basic things, and look at, I'm not a fundamental guy, but 18 is the PE. That's only 80% of what the average S&P 500 stock trades at. Another negative is it's a Brazilian company. They find, fintech Brazilian. I don't generally trust the, foreign companies rather. However, this is pretty compelling looking. The chart looks really nice here. So let's take a look at the shorter term time frame. On a 15-minute time frame, you can see we just broke from what would look like a cup and a handle here. It gapped up. It's been holding the anchor kind of since then. We had what appears to be a shakeout today, and we have a catalyst coming next week. So the earnings, again, are on the 13th. This one looks like we've got to keep an eye on this thing. If you were ever going to make a bet on earnings, and I'm not going to do this, I'm not suggesting it, then buy call options on this stock. You know what you're going to lose. But the dumb money is out, and that's really important, because why on earth would you buy starting right over here, buy all the way down to there, stop buying right there, start selling in here, and then really get aggressive on your selling right before it looks like it's ready to break out, right as the earnings are looking good? I don't understand the logic. Big money is not smart money. This is one we're going to keep on our radar.